Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome back. How's everybody doing? Hope you are doing well. Focus Compounding, Andrew Kuhn. Focus Compounding, Geoff Gannon. How's it going, Geoff?
It's going very well, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else. If you are not subscribed to Geoff's free weekly gazette, go to focuscompoundinggazette.com and make sure you get on that list. You'll get an email from Geoff once a week, Monday morning.
Yes, and it'll have at least one stock idea. Some recently have had 2 stock ideas, and it has something from you in there too.
That's right, all for free. So be sure to check that out. Also, if you're not following me on Twitter, be sure to give me a follow at Focus Compound. I tweet out content all the time. And then when we go over questions like we're going to be going over today, you could also ask questions of me. So be sure to check me out there. So today is, what's today? July 30th. NACCO reported earnings, or is it the first today? Whatever, doesn't matter. But NACCO, they reported earnings yesterday. And,
yes, correct. They reported yesterday. And
NACCO Industries is a stock that you've written about a lot. And then obviously everyone listening pretty much knows that we own that stock for our clients. And an individual asked on Twitter, said, what do you guys think of the first half of NACCO's year? Like, how do you think they're doing for the first half of the year? They just reported Q2 earnings.
Yeah.
So maybe give a little snapshot on that.
Good. I mean, royalties went up a lot, and then tons of coal sold went down somewhat. I think we talked offline, we talked off air about how you were asking me what I thought about some things, and things that I said were just for this quarter. The only things were that maybe royalties were a bit higher than I expected, and tons of coal were a bit lower, especially with the sort of guidance that they give for the future. Sound like it would be fairly low. So the coal business won't have as much volume as I was expecting for this year. Royalties very high. But we knew that from the first quarter.
Yeah.
And so, and the huge change in the company is that, probably at this point last year, 2/3 of their earnings probably came from coal, and this year 2/3 probably comes from natural gas royalties. I don't remember if they changed language saying that they would consider changes to the asset base, meaning like buying other things that might have royalties. If that's new this quarter or last quarter, but that was included in this quarter's press release, so that is different from last year, certainly. They might buy reserves, I mean, that's not exactly what they said, but that's what I inferred from that, Stock was up a little bit before, didn't do anything that I know of since the reported quarter, and isn't that different from where it ended a few days after last quarter. So,
I mean, the way I viewed it, it wasn't like it was just kind of like a business as usual quarter, is the way that I thought about it.
I mean, the first quarter was the one that would have changed the market's perception of it or whatever. Yeah. This one, they basically told you that royalties were going to keep going up quarter over last year quarter. Each quarter would be higher than a year ago quarter, but that it would be at a lower rate than the first quarter. Now, actually, it was at a really high rate for the second quarter, so I assume that means that they're saying that the third and fourth quarter will be at a much lower rate of royalty growth. But for the year, it'll be up a lot. And as we said, the PE, despite the price increase, hasn't increased at all.
Yeah, they've earned about, I think, $3.30 so far in the year. So they're still on track to probably earn $7 to $8 a share.
Yeah, and so a while back, I think I said, based on the first quarter, that you can assume they're telling you they'll earn between 6 and 9. Yeah. They're still in that range. Yeah.
So it's still trading at 7 to 8 times earnings.
Yeah, it was 50 something. Very low 50s. Yeah. I did a whole podcast on it. Yeah. So not on this podcast, but I did a whole interview. You tweeted that out, I think, recently. Yeah. So that's a really good one to listen to because I talk about NACCO for 30 minutes, and that was after the first quarter, but not the second. But since barely anything changed with the second quarter, what I said in that podcast is pretty much the same, and the price was pretty much the same at that podcast. Yeah. So definitely go and check that. Is that the Intelligent Investing podcast? Yeah. So if you go to the Intelligent Investing podcast, look for my name or look for NACCO. That's how you'll find it, and it's probably 30 minutes long or something, and it's all about NACCO, much more detail than we've ever talked about on this podcast.
So far, though, you still like the company, still feel business as usual.
Yeah. I feel it's the same as a quarter ago. The price is pretty much the same, and it's done what I expected.
Yeah. And you still think it's very undervalued?
I do think it's very undervalued, yeah. I mean, there are risks, obviously. This is all coming from coal and natural gas.
Yeah.
So each of them have their own cyclical sorts of things. Coal has a secular long-term decline possibility, and natural gas in Utica, is a large part of this company now is going to be natural gas in Utica.
Yeah, I wonder if the market's going to value it differently because
the majority
of the earnings do come from
over time
now.
it should attract different shareholder base and everything from that, because although it's not a natural gas company technically, it's going to fall into that category, and it should attract a whole different group of energy type investors. Yeah.
Cool. Let's see. Next question: when is a good time to exit an investment?
Oh, when you made a mistake.
Yeah.
From buying in the first place.
Uh-huh.
That's the reason. There are other reasons. We've sold some things.
So that's on the downside. So when you think you made a mistake.
That's almost always why.
Yeah.
I shouldn't say that. It's not almost always that I made a mistake and I sold. The other reason is to replace it with a stock you like better, which is actually the most common, most common reason. But the reason to sell just to hold cash is you made a mistake. Mm-hmm. And it would depend on your size as an investor and stuff, some of this too. It's really, you don't have to sell anything in preparation for buying things really as a really small investor. As you get bigger and you're managing money for other people and stuff, then sometimes you might need to keep a little cash around and stuff. So sometimes you might sell things because you think you're going to buy something soon.
Yeah.
I'll, by the time this comes out, have already done a letter to clients that'll be talking about that fact about selling because we see opportunities to buy other stuff. But it'll just sit in cash for a little while until that happens. But as an individual investor, you don't need to do that. You can sell and then immediately buy what you want. So you can be 100% invested.
And you wrote an article once about have any of your sell decisions added or detracted from your performance, and how you concluded that when you sold a stock simply for the case of just raising cash, it just wasn't worth it, as opposed to just being fully invested all the time and only selling a stock when you want to replace it with a new idea that you like more.
Yeah, if I was right about the business, then it wasn't a good decision to sell. Now, that it's just been luck or whatever that the kinds of stocks I bought or whatever haven't gone to insane valuations usually. I talked once, several times before about I bought FICO and sold it in like a year or something. It went up a lot. I sold it. If I kept it for 10 years, that would eventually become a problem because the PE got to be 30 or 40 times or something. So it would have gone to a crazy valuation. That's the sort of thing Buffett faced with like Coke and Gillette and things like that in the late 90s. But aside from like a really crazy valuation, no. If you buy it at 13 and times earnings or something and it rises to 30 times earnings, usually you can hold it through that time and just buy when you have something better to buy it with, sell when you have something better to buy. I don't think you have to worry, is this something I need to sell at 15 times, 20 times, 25 times? It's not that specific that way. If you're in the right business and you don't have a better idea, stay in the business you know well and that is the right one.
Yeah.
But making a mistake, and I've sold for that before. The biggest reason is like you misunderstood the predictability of the business, especially the competitive position. Although the most common one for me selling would be a change in capital allocation. So that by far is the most common. And if you see something suddenly drop off the watch list, look into capital allocation, because a lot of times that's why the company has changed something about their strategy, and so then that's why I sold or something. And we did something where we talked about Majestic Wine one time or something where I looked at and stuff, and then they bought like an internet wine company and stuff, and then that just was off the watch list, right? So that kind of thing happens a lot where they go into a different business or whatever, acquire different things. That's the most common reason for selling. Yeah.
Cool. Next question is KLXE. Buy at the current price, and we talked. I don't know if we talked about it on the podcast. I know we privately talked about it. We looked at it when it was being spun off, and it's currently trading at $13.59. We were talking on the way here. You said the last time you looked at it, it was like $22.
Yeah, last time I studied up on it, whether I would buy it or not, I was at $22 a share.
And when the company originally was spun off, it sounded pretty great. I mean, the company was going to spin off with net cash, no debt, for like 5 times EBITDA or something, incredibly cheap. And then when they actually, and the management was being compensated from equity within the company.
Completely in equity,
their track record is great. I think they're straight money makers. Past 3 companies that they ran, they've sold. So kind of had all of this. The stars were aligned. And then they spun off, and then they announced that they were raising a bunch of debt.
To buy more stuff.
Yeah.
At even lower EV/EBITDA ratios than themselves. Yeah. And they issued stock to do that and stuff. So they've made acquisitions since then. So it's not a surprise what they've done and how aggressive they've been. So this is a spinoff of a spinoff. So BE Aerospace was the original company. They spun off into something called KLXI. And now this is KLXE. KLXI, what happened was that Boeing wanted to buy the company for the aerospace. It did not want to buy the energy. Or if you read the details on the deal, management had a higher valuation on the energy company than other people were willing to buy it for, at least if they also took the aerospace. Maybe if you sold them off in two separate deals or something, you could work it out. But you can read the background to that deal in the KLXI SEC filings, which are still there. The SEC keeps up filings from companies that no longer are around. And you can read in the proxy thing, they're identified as like Company A, Company B, Company C. They don't say who they are, except I think Boeing, because that was public. But you can see who offered what, under what terms to buy it out, and the energy part of it, and how they thought of it, things like that, and why management didn't take that deal. It's leveraged now. It's cheap. It's cyclical and risky that way. I definitely think it's the Joel Greenblatt value investment type thing.
Sure.
And it definitely, of the spinoffs that I've seen, it looks like one of the most interesting. I don't know how well it works for the kinds of things that we normally buy. It's definitely a lot more volatile than what we tend to buy.
A lot more levered than what we tend
and
to buy.
It's a real commodity type thing, really, really cyclical. It's not unusual for them to double their earnings in 1 year and then be down 50% the next year. But they do things like, some of their work involves completions of wells and things like that. So there's other things too, but that stuff is obviously very cyclical. So we're talking about in the United States, oil field services that has to do with, so only in the U.S. And it's a different industry than what we normally buy into and stuff like that. But it looks very cheap. Obviously, on an EV/EBITDA type basis, it looks very, very cheap.
Yeah. Does it get you more interested with it trading around $13? Like if
Then
you were
at
running your
or
own,
something,
if you're running your own personal money, do you think?
Yeah, definitely, it's more attractive at 2/3 of the price.
Yeah.
Yeah. However, it's not 2/3 the enterprise value; it's 2/3 the market cap. So
Because of that
debt, yeah.
Would you be more interested in it though now if you? I understand that it's fallen, but I'm saying if you're running your own personal money instead of having to find stocks for clients.
Maybe, but even for clients, I'm interested in it. I'm watching it.
Yeah.
If the markets were to decline a lot, or especially energy-related things, people really got put off that kind of thing. Yeah. I mean, if you were to enter a recession or something like that, if you have a company with a fair amount of debt and tied to energy stuff, that stock can go down a lot.
Sure.
So it can be, you can get a real opportunity to buy something cheap when that happens. I mean, any of these companies that have a lot of debt and stuff, you'd be surprised what can happen to them in the slightest recession or something in terms of how their stock prices will go down when there starts to be fear about that. Because right now there's no fear about anything that has a lot of debt. There's no problems handling that debt, but in a different situation economically, it's the kind of company that's very economically sensitive, so it would be one of the first things to turn down in a big way, and I guess it already has turned down.
Yeah.
But it's the kind of thing that you might get offered at a really good price temporarily, and that's the time to buy these companies that are so cyclical and stuff, is at a bad time in the cycle for them, and a bad time in terms of their popularity as a stock. Yeah, it was. I don't know that it was that unpopular initially as a spinoff. It definitely got talked up a lot by value investors.
Yeah, it was written up a lot on.
It checks every box that Greenblatt talks about, right?
Yeah.
Yeah.
Management's compensated. It's sort of the redhead stepchild.
Yeah, I mean,
deal.
In terms of the deal that happened, 90%. So I'm saying it's a spinoff. That's not really exactly what it is. It was a spinoff, but 90% of the company was being bought by Boeing.
Yeah.
So it's a combination there where it's not your usual spinoff. It's even less likely that the people who'd be selling out to Boeing for cash and stuff would want that.
Yeah.
And obviously, arbitrageurs came in and bought things by then. So it probably didn't have much of any shareholder base by the time it was spun off.
And they. If you think about it too, management clearly thought that the company was undervalued because they got a bunch of offers from people prior to the actual spinoff.
Yeah, management could have just retired too in terms of age and stuff. Yeah.
So it could be interesting. Yeah.
Yeah. They obviously, management likes it a lot. They took their compensation all in stock, bet even more in terms of like taking on debt, issuing stock, whatever, to do more deals with other companies around
so they only
the
diluted
country
themselves, right?
Yeah. But they did it at valuations which, in terms of the EV/EBITDA, I would say made it even cheaper. They weren't paying more they weren't empire building, buying these other things at prices that were higher than their own price. They were buying more and more stuff at low EV to EBITDA. But obviously, people in the industry and stuff must be comfortable with the idea that companies shouldn't trade at a high EV to EBITDA right now. Mm-hmm. Yeah, but when you read the write-ups by investors, they say that this is like the middle of the cycle or something, that this isn't a high point in it. So
could be interesting.
Yeah, we already have one thing that's very exposed to natural gas in the U.S. though.
Yeah,
NACCO. So
yeah, may not fit our portfolio. Next question: how do you guys think about currency over or undervaluation when buying foreign stocks? And he said that he listened to one of your podcasts that you did in the past, and that how you put off buying Howden joinery because you thought that the pound was expensive relative to the dollar.
Yeah. So Howden Joinery is a stock in the UK, and it does. You can think of it like a super small Home Depot or something, serving just the builders though. So it serves them on confidential terms to supply things like if you're going to put in a new kitchen or something, remodel your kitchen, providing cabinets and things like that. All the things that the builder would need. Does it privately. It's great business. Anyone who doesn't know about Howden Joinery, you should go look at it now. Does a great job of explaining the company, all that. Now, in terms of the currency thing, yes, I thought the pound was overvalued back then. And that's just purchasing price parity, basically. So purchasing price parity is basically the easiest way to think of it is the Big Mac Index. You're familiar with the Economist Big Mac Index? No. Okay. So the concept that the
Big Mac's like from McDonald's?
Yes. So the concept that the Economist had, the magazine, is that a Big Mac should cost roughly the same in every country.
Okay.
If it doesn't cost the same in a country, it's because of differences in the currency. Because the Big Mac isn't being traded across borders and things, right? So you're using local labor. You're using somewhat local ingredients and all those things. It's even changed a little bit in each country to meet their tastes and all of that. But basically, you can look at it that way. And so it's a really good indicator that way of how you do it.
Every day.
Yeah.
I never knew that.
So
I was actually I was joking around when I said McDonald's.
It is McDonald's. Yeah. It's absolutely McDonald's. Yeah, it's big because McDonald's is everywhere.
Sure. I mean, in theory, it makes sense.
Well, no, that's a huge problem in doing this kind of thing. In terms of purchasing power parity, when economists actually do this between things, the problem is the baskets of goods are not the same. I mean, if you've been to other countries, you've been to the United States, and you try to compare them, they're not as comparable as a Big Mac in each country. Sure. That actually is an issue. If you say... there's certain countries in which the quality of some things is much lower than it is in other countries of what they're using. Like, if we were talking about in the watch list when we talked about Corellia tobacco or something, there's not a guarantee that the cigarette quality in all the different countries is the same. Some countries are importing only high quality cigarettes, some much lower. And then you have taxes and things. Big Mac is a really easy way to do that. So that's one way of thinking about it. And it tends to be the same in general. It's not as precise, but in general, the Big Mac Index actually is pretty accurate in matching up with purchasing price parity. So if you go someplace, Denmark or Switzerland or something, and you say, wow, that's a really expensive Big Mac. So if you figure out that I traded my dollars for whatever this currency is, and I just paid $7 for this, whereas when back home it's this price, then something is off with the currency. And that tends to be true.
That's interesting.
And it really captures it for very expensive and very cheap ones. Now, there are economic theories about reasons why the lower GDP per person that you had in a country should mean that it's okay for you to have a lower price than you'd expect on purchasing price parity, and then vice versa. So if you had very high GDP. But if you're comparing two countries that have similar real GDP per capita, it should be very close. There's no reason really why a Big Mac should cost more in Norway than in New Jersey. They should cost about the same. And if they don't, then something's probably off about the currencies between the two countries, which probably has to do with issues of interest rates and things like that.
Yeah.
So the main thing is purchasing price parity, I'd say, is something that I have in mind. So, which the simplest way to think of it is what I just said with the Big Mac Index, except it's over a wider basket of goods. And you can find that in different international organizations publish information about that, whether it's the OECD or something like that, you can find it. So I would use that, and when it seems really unusually high or low versus the dollar, that would be a problem. I invest in Japanese stocks knowing that the yen was overvalued, and it declined while I owned the Japanese stocks and made my returns worse. I could have hedged it. And so I've talked about that before. If I made 20% or something, 20 to 30% a year in Japanese stocks, you could have made, 40 to 60% a year or something for the year or two that I owned it in those stocks if you had hedged the Japanese yen. Because what happened is Japanese stocks went up a lot while the yen versus the dollar went down a lot. You could do that. In the very long run, I don't think there's good reasons why you would necessarily want to hedge that out from a volatility perspective. It doesn't have a real relationship that would cause your portfolio to be more volatile, so why do it? Two, if you happen to ever be in a country where there's some problem with runaway inflation or something, it's not necessarily a bad thing. That in a sense is a good thing that you own some stuff in other currencies, so it's not bad. And then you also have the issue of does it actually add or detract from returns? It actually should.
What if you're wrong about the currency? So
that's
say you hedge it. And then
that's why people hedge it. That's why people hedge it. And I think they're probably wrong to do that. So they hedge it so that if they were right, they don't have the experience of regret that I was right about the stock and yet I didn't make money, right? But in reality, if you make a bunch of different bets in foreign countries by buying different stocks in foreign countries over decades, I don't think you will come out ahead by hedging. And there will be some cost to hedging. And it'll be a distraction that you have to worry about these things. So in general, my advice would be don't hedge. However, it can be obvious that a currency is overvalued or undervalued, and that could continue for a really long period of time. But it's the same way as, like I say, sometimes it was obvious that oil was too expensive at $110 a barrel, or it was obvious the Fed funds rate was unusually low at 0 to 0.25%. That's what I'm talking about. Yeah. It was obvious to me in the yen that seemed to be what was happening. In terms of how to join rate, I was a little concerned with the UK versus the US. It's rarely, in the time that I've been investing stuff, only certain countries have had this happen versus the US. A lot of Northern European type countries and Japan, not a lot of other ones. So it occasionally becomes an issue. You could hedge it, and that may be what people want to do. The other option is just to naturally try to benefit from it and say, well, companies in countries that have low currency values versus the U.S. would be attractive places to hunt for a stock, and those with high ones would be places to avoid. So if you look at it and you say, oh, well, this year Mexico looks really attractive in terms of the currency and Switzerland looks unattractive, then you spend more time looking at Mexican companies than Swiss companies, something like that. Long term, there are reasons why a currency could be bad in one country or another, and it just has to do mainly with their things that they would do that would cause their currency to inflate. So, and they're pretty obvious. So, the central bank would like to avoid inflation. It would be a more likely place where you'd want to invest. There are a lot of emerging countries where purchasing price parity might not make that much sense, in that you might just want to avoid the currency altogether. But I think that's a bigger issue of more things like whether they would ever put restrictions on people getting capital out of the country and stuff like that. So there are reasons to avoid certain emerging markets, but I don't think it's just because of the currency price. It was just that the purchasing power parity was telling me that the UK was really overvalued versus the US at that moment. And then that changed with Brexit and things like that after that, and things that changed in the US too. You just had a change in that got me more comfortable looking at the stock. But it's just outliers. Sometimes, at that moment, the UK might have been in the top 10 or 15 countries in terms of how overvalued they seemed versus the US.
Sure.
And it's just that there's certain things I avoid that way. So you could hedge it. There's nothing wrong with doing that. But I've also talked to people in countries in Canada or in Nordic countries or something about real estate or something. I said, I'm not interested in it because just in terms of the prices, it looks out of line with the long-term trend. That's what I'm talking about with these currencies. You could do it the same way. It should be very obvious if you study up on the currency at all that it looks wrong. The easiest way to do that is the Big Mac Index, purchasing power parity, things like that. But there are other ways to know long term. What I care about, though, is that the short term stuff is all momentum and things in terms of these currencies that people are talking about trading. You don't want to worry about what traders are talking about the currencies. You just want to worry about the really long term stuff, and what that is really is just whether the prices seem normal or there seems to be something that's really wrong. And sometimes there are price differences between countries that are very significant in in their currencies, and that's some sort of imbalance that's happening. And it will probably correct itself eventually. And you don't know how it will. It's the same thing with oil or something. I had no idea how oil would get down in price or whatever, but if people can make a lot of money by doing that, they will. In these countries, if it becomes impossible to export from these countries or something, eventually that's going to cause things to happen with their currency. The same things will come in that will drive it back to a reversion to the mean. Mm-hmm. So that's just the thing to look at long term, is whether, and honestly, the first place you could go is the Big Mac Index, because I think it's online that you can find it. It's easier to understand, whereas tables of purchasing power parity are a little harder to understand. The CIA World Factbook, I think the CIA always puts GDP in both adjusted to U.S. dollars with purchasing power parity, and then also just according to exchange rates. And when you see a big difference between the two, then you know for that year that there was a big gap. So certain countries come up that way. That's a thing that you see in statistics sometimes, where they say some countries very rich versus the U.S. or something. Often it's not. It's that their currency is highly valued. So the reporter just did it using exchange rates. So like, say Denmark or something. That's correct if someone in Denmark made all their money in Denmark, then came to the U.S. to buy things.
Sure.
It's not correct if they go about their life in Denmark that they're actually that rich, because they have to pay whatever prices are there in Denmark, Mm-hmm. So
it's relative.
Yeah. And so you can figure those things out. I think everyone should spend very little time worrying about currency, as little as possible.
Just go to the Big Mac Index.
That's the place to start.
Yeah,
it's the easiest
cool.
one for you to understand.
I never knew about that. So
there'll be a little graph there that'll show you on the world and what is very expensive and what's very cheap.
And what it is here, and then what it is all over the world.
Yep, and the percentage over valuation or undervaluation based on that. Yeah,
that's so cool.
Yeah.
Learn something new every day.
Well, that's a good place to start.
That was awesome. That was cool. Well, I want to thank everybody so much for tuning in with us here today. If you like the podcast, like the work that we're doing, if you give us a rating review, that helps us out a lot. Obviously, this is free, but that helps spread the word, which obviously Geoff and I love. So I want to thank everybody so much for tuning in with us. We will see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.